So what exactly is short selling? Of course, short selling is not an easy job. Simply put, short selling is the process of selling securities which an investor doesn't own. Sounds strange? The logic behind it is not, though. Short sellers sell something at a high price because they believe that in the future they can buy it back at a lower price, thus making some profit. So, how do you sell something that you don't have? Well, loans. Remember? You actually borrow a security from a person or a company that owns it. Just like in loans, you need to pay interest because you use someone else's stocks. Short sellers pay fees to the owners. What will happen if the price goes up when a short seller sells the stock instead of going down as planned? In such a case, you will have to pay additional money to buy the stocks at a higher price than you borrowed it. Therefore, the amount of a profit of a short seller can make is the difference between the two prices, the sale price and the purchase price. Keep in mind that short selling is riskier than the normal way of investing in stocks. If an investor purchases some stocks, all they can lose is the value of the stocks. But when you borrow something and you pay fees and eventually the value of the stocks plummet, you can be a big-time loser. Still can't get the idea? Let me give you an easy-to-understand example. John wants to try short selling. He goes to Adam and wants to borrow from his stocks, which currently trade at $50 apiece. Adam agrees to lend him 1,000 shares at $50. For that, John has to pay a fee because he's using someone else's assets. Now, why does John want so eagerly to short sell? Let's imagine that he's been doing research for 6 months, and he's estimated that the mentioned stock will lose its value in the next month. In his trading account, John has 1,000 stocks, each at $50. He sells them and receives $50,000. Part of this money will be kept as collateral, protection against losses. After the sale, there are two possible scenarios. The price of this stock does indeed fall in the next month to $35 per share. John, therefore, buys back all the 1,000 shares and pays for that $35,000. His gross profit is the difference between the prices, $15,000. Gross is not net, He has to pay fees and other costs. 2. The price of the stock could go up to $60 per share. The amount you have to pay for buying these stocks is $60,000, meaning that John has generated $10,000 of losses. The amount of profit or losses in the example are gross. Keep in mind, anyone dealing with buying or selling stocks will have to pay various fees, costs, and commissions along the way. However, one question is still open. How do you sell a stock that you don't possess? You already know the short answer to this question. You have to borrow the stocks from someone who's willing to do so. The process is actually not so difficult. Once an investor agrees to lend you their stocks, they will relocate their shares to your account. But why would anyone agree to do that? It's all about business. If you're trustworthy, an investor will lend you their shares because you will pay them an interest on the loan. That's it for now. On our website, you can find more posts as well as calculators and other financial tools. Do you plan to short sell? We would love to know your thoughts, so feel free to share them with us in the comments below. I hope you enjoyed it, and don't forget to subscribe to our channel on YouTube to get more free financial education videos.